Well, Dhiraj Agarwal is now joining us. He's Managing Director, Ambit Investment Managers. Dhiraj, great to have you with us
Hi,
here.
good morning.
Appreciate it. So how are things looking? I mean, should I be asking that question? It's absolutely fine, right?
Yeah,
how will they look is the question from here on.
Things are looking fine. I think March volatility was a little torrid, as you mentioned on the show a little while ago. That with March, quite a large number of names, which were the best performers going into March last 6 or 8 months, took a bit of a knock, right? So mid caps and PSUs all suddenly fell 15-20% in a span of 7, 8, 9 days, and mid caps maybe 3 or 4 weeks. All of them seems to have clawed back. So two things are helping the market sentiment in the near term. There is a clear dovish tilt by the Fed in the March 20th meeting, although they keep on going a little bit back and forth in the subsequent statements. But I think on the whole, the tilt is dovish. And second, our strategist was telling us that most 2 months or 3 months going into elections, the markets have been strong because the optimism starts to creep in what the new government will do, things they could not do in the previous term.
We'll get manifestos shortly. I mean, I think next week we'll get the manifestos, right? And
Yeah.
people will pore over them.
Correct.
Hopefully they'll be well detailed on the economic front.
Correct.
So that should act as a trigger.
Yeah, that could act as a trigger. And optimism is building up that number of unfinished agendas of the last term could get completed in the next term, etc. This always happens. So, yeah, we could see a near-term bit of a move. Medium term, I think the markets will continue to be choppy. That's my view.
Okay, so near term you could see a move. But we're getting a lot of questions from viewers, from investors about what happens post the elections, right?
Yeah.
Because if this is a build-up to the elections and once that whole election trigger plays out, then do we normalize to sort of, I mean, are we getting into sort of a time-wise correction for the market? Is it going to be a period of no growth at all? How do we approach it throughout this calendar year?
So throughout this calendar year, I've been of the view the markets, what I call it non-linear. So we saw sort of a linear markets over the last 12 months. Very small pullbacks and markets kept on rallying. This year, I think markets will be non-linear. So you'll see a lot of ups and downs through the year. For the whole year, I wouldn't be surprised if we close the year in a plus minus 5% range and not a huge return the way we saw last year. The reason for that is if you see the earnings performance of the large caps, there's a lot of dispersion trend. So capex oriented or investment oriented businesses are still doing okay, but they're slightly richly valued. Consumption weakness, which started with only rural weakness a quarter or 2 quarters ago, now seems to be percolating upwards even to the urban products and demand. That's a little bit of a worry. So there are cycles and then there are counter cycles which is happening, which in my view is a little bit of a risk for earnings going forward. And the margin benefit which the company's got because of sharp fall in WPI will start to fade away soon.
You know, I was just wondering, some of these commodity prices are moving up. What's going to happen to some of those, you know, say those wire makers, those cables companies? You know, suddenly you'll start factoring in that, hey, commodity prices are going up, but that's what's going to hurt the margin. So let's see how that goes. But since we were on the topic of elections, and I think that you were in the camp that's like two-wheelers, you know, what are the other themes you look to play? Staples have been big underperformers. We had a note coming in from Motilal Oswal who said they rather look at staples now in comparison to discretionary, where discretionary actually has been the big outperformer. But they believe the time has come to look at staples. Your take?
I continue to be slightly negative on staples.
Okay. And the two-wheeler theme you still like?
Two-wheeler theme I liked, but from the current prices and the current valuations, I'm slightly more cautious.
Okay.
The stocks have done phenomenal run. For example, Bajaj has done almost 50% kind of a run over the last 5 or 6 months. Hero has done beautifully. So has TVS. So there's also how, I mean, market these days tend to price in year and a half or 2 years of outlook within months, right?
Yeah.
So it is the second thing which I've been continuously saying, and I've, I think mentioned this a couple of times on your show, is it's a very retail-driven market.
Yeah.
So two things are happening. One, near-term earnings triggers get immediately priced in. Second, there is a huge amount of weightage on growth over everything else. So, you know, the whole valuation framework of the market keeps on moving. 2014 to 620, all of us moved to just DCF, and we started talking about terminal value and what's the long-term value in the particular business or stock. I think we have done a full round trip and gone back to 90s, which is plain and simple PEG. what is the growth and what is the PE relative to that growth. So, which is why when slight amount of growth disappointments, you see sharp pullbacks in the stock prices as well. One is the business. Second is I would keep an eye on what the valuation respective to the growth is.
You know, retail is driving the stock market, but the government is driving some of the policy-led initiatives, right? Which is leading outperformance in sectors, infrastructure, capital goods, railways, metros, defense, etc., etc. You said unfinished agenda, market will focus on. Very quickly, we'll get to know what's in the manifestos, etc. But to your mind, I mean, at the team at Ambit, what's happening? What's the view like? Which are the sectors where this unfinished business will find most resonance in?
I think in terms of sectors and specific push with respect to either the capex plan or PLI, the government has already done a fantastic job. What I would like to see, I don't know whether this will happen or not. What I would like to see is the.
We all have our wish list. Go for
it. So the labor reforms, which was attempted but pulled out, comes back on the table with the new mandate.
The labor reforms, sorry.
Labor reforms which are tabled and sort of pulled back. Some structural changes on the agriculture side, which was also tabled and pulled back in the previous term. I hope some of it comes back because it's time we do touch some of these holy cows in the country, and same for land acquisition. So the next big thrust India requires is manufacturing. There's a lot of articles and strategy reports being written on why, despite the economy doing well and GDP growth being strong, unemployment problem is still not fully solved,
so
and that can be solved.
There is just one thing. The interim budget which came, right? Look at the allocations made there across railways, across roads, etc., etc. Many of these areas, allocations actually, the growth in allocations has slowed down materially.
Correct.
And that's the reason many economists pointed out that there's only so much the government can do.
Correct.
Right? There's absorptive capacity of the economy as well. You can't just keep putting in money into these sectors. That will not change even as they come back. So what does that mean for, as a theme is great, capital goods and PLI, etc. But you're reaching limits in terms of how much more the government can do. It's the private sector then.
Yeah.
Will that show up in that way in stocks as well? That maybe they take a back seat. That remains the focus, but the government is kind of taking a back seat as they've told us, and that perhaps will not change when the full budget also comes.
Not necessarily, because see, many of these companies have notched up order book. So book-to-bill ratio is reaching 3.5, 4.5 times, right? I'll just give an example of BHEL from 2003 to 7 or 2004 to 7, just to illustrate my point. So bulk of the order book for BHEL actually came pre-2004. But bulk of the execution happened between 4 to 7. And while generally it is believed that capital goods companies perform only when the orders come in and not when the earnings are delivered, it's not really so. So capital goods start to perform when the orders start to come in. But if the earnings growth is also very strong, the performance continues. So over 4 to 7, BHEL delivered on the projects, executed, and in power projects, typically the last 2 years is when most of the margins also get booked. So as the projects come for completion, the margins also see a bump up. And it was one of the best performing stocks of that time period. So same thing can happen here. Fresh order intake might slow down, but book to bill is 4 times, 4.5 times in many of these cases. As they get executed, and towards the second half of execution is where bulk of the margins get booked. Earnings growth can still stay robust.
Okay, by the way, the stock of the moment is Avenue Supermart. Just look at that, 5.5% rally now on that stock, and big volumes coming through as well on Avenue Supermarts this morning. The market cap has now exceeded over 3 lakh crores for Avenue Supermarts. It has come back in a big way. It just talks about how perhaps consumption has come back, right? But just trying to get your view on this entire sector. How do you pick and choose in terms of both valuation as well as growth now?
So, 2 or 3 things. One is, one of the biggest trend in the consumption sector is formalization. That trend started in, let's say, 2017 or 18, gathered pace post 2020, 21. So there are a few spaces, and Avenue is a classic example of that, right? So there are a few spaces within the consumption space where even if the headline growth is a little slower, some of the stronger names in the sector can continue to grow at a very fast clip because informal is still a large part of the pie as compared to the formal. So grocery retail is one such example where informal is still a small fraction. And hence, the more organized retail in grocery has a very long runway of growth, which is what Avenue is benefiting from. The growth had slowed down a bit. A small sign of a pickup in the last 2 quarters, and the stock's been doing very well. There are a few spaces. I mean, jewelry is another such example, where still the unorganized has a large section of the whole pie, and hence the organized can...
So at this price and at these valuations, you're still comfortable with names like Avenue?
I mean, I'm not commenting on the specific stock price move here, but I think that's you asked me a question on what the framework one should use. The framework I think one should use is if there is still large informal to formal shift happening, at least one can take a bet on a longer runway for growth. And then, I mean, valuations is another matter. You have to link it to that.
All right, Dhiraj, appreciate you coming down to the studio and sharing all those thoughts with us. Wishing you a good day ahead and look forward to having a chat with you rather soon.
Sure. Thank you.
Well, let's focus on another company.